All right, let's go on to the program. We have a great panel waiting patiently here. So disruptive technologies such as WeWork, Uber, Airbnb, and Amazon continue to have a tremendous impact on the real estate industry in our cities. While most of the focus has been on threats to the commercial real estate industry, our panel takes a fresh look at the opportunities within commercial real estate to partner with and profit from these emerging formats as they continue to revolutionize their segments. Our moderator for this session is Natalia Martinez-Kalinina, General Manager of Cambridge Innovation Center in Miami. CIC Miami just celebrated their official opening a few weeks ago. I'm sure some of you were there, and they are leading a dramatic, really exciting repositioning of UM's Life Sciences Park as Converge Miami. They will be a hub of entrepreneurship and technology, and they're poised to grow into a full-blown innovation district in the years to come. We've asked Natalia to tell us a little more about CIC Miami as part of this panel, and I'm going to introduce her, and then she'll take us off into this first group. Natalia is an organizational psychologist and strategist focused on merging innovation, entrepreneurship, and community impact. Prior to CIC, she served as Chief Innovation and Technology Officer for a youth empowerment nonprofit in Cuba, as well as a product strategist for Ultimate Software, a global $4 billion human resources software company. Please welcome Natalia Martinez-Kalinina.
Thank you. Can everyone hear me? Yes. Thank you, Chuck, for that wonderful introduction. Thank you all for having me here. It's exciting for me. As Chuck mentioned, I'm an organizational psychologist by training, so my foray into the technology world came a couple of years ago, and my foray into the real estate world is even more recent with the CIC project and heading our expansion to Miami. So it is a pleasure to be so welcomed into this community. It's an industry that's important not just locally, but obviously for the rest of the country. But here we feel it very acutely, and so thank you for the warm welcome. I will give a very brief introduction since I was asked to about CIC, but then we'll move on to our panelists who are much more exciting and knowledgeable than I am in these topics. The Cambridge Innovation Center, CIC for short, was founded 17 years ago in Cambridge, Massachusetts, as the name would imply. We've since become an innovation district builder, so we are kind of not single-handedly, but in partnership responsible for what has become the flourishing of the Kendall Square area in Cambridge, if anyone has been there recently. We also have projects that have expanded into Boston. We have about 350,000 square feet of office space in the Cambridge and Boston area. That does not include some projects that we also have in direct partnership with the city of Boston and the state of Massachusetts that are meant to be open and accessible innovation centers to the average person that's not related to CIC and doesn't have to be our client. We also co-founded about a mile down the road from our headquarters what has become the premier life sciences accelerator in the country. It's called Lab Central. So we're very much into this idea of straddling entrepreneurship and innovation and the life sciences and how those elements and those stakeholders can merge to really drive community gravitas in the community and progress. Outside of Massachusetts, our first U.S. expansion was in St. Louis, Missouri, where we're also part of an innovation district. In that case, it's called Cortex. Miami is our fifth expansion. Rotterdam in the Netherlands came before us, so we're kind of following in the footsteps of our first European foray. And we just opened officially our doors in Miami on October 24th. We are within what was formerly called the University of Miami Life Sciences and Technology Park. It has since been rebranded as Converge Miami with the intention of being institution agnostic and more open to other partners and entities. And aside from the one building that we're currently in, we're part of a triad that is working on this larger innovation district master plan that will occupy the rest of the parcel and over the next 5 to 10 years connect the health district here with the rest of the innovation corridor in Miami. So that's the project that I lead, and I'm very excited to do that. If I look tired, it's because I am. This has taken over my life for the last 2 years, but in any case, I'm very excited to be here. So I'm going to let our panelists introduce themselves so they can take that opportunity to not just talk a little bit about who they are, but walk us a bit through their business models, and in the case of Bob, a bit through their kind of investment philosophy. And so we can kind of start working our way back this way. James?
Hi, I'm James Bree, Executive Vice President, Development and Construction for Seritage Growth Properties. Probably a lot of you have heard of us. We bought 266 Sears and Kmart's in 2015 and have been repurposing the properties. We're out there, we've started 50 in the last 18 months, about $450 million of capital investment to date. We're generally bought the properties for about $65 a square foot. We were collecting and are still collecting an average of $4 in rent from Sears, and then we take it and have been able to achieve an average of $18 of rent for Sears and getting an incremental return of around 12% on our investments. Everything to date has been pretty much core retail development, bringing in, so taking the single purpose building, putting in multiple tenants, bringing in grocers, cinemas, and health clubs, as well as traditional value players and higher end, larger format retail users. We still see that the market's very strong. We did over 2.2 million square feet of leasing last year in our wholly owned assets, and we're looking at 2017 still being as strong, if not stronger. That's what we do.
How's your stock doing?
Stock's okay.
I'm Bob Graham with Rockwood Capital. I'm one of the founding partners of the firm. I'm in San Francisco, the epicenter of all things disruptive. We are a private equity firm. I think the best way to explain what we do is we invest up and down the capital stack across geographies and different strategies from value add to core. And we're primarily in office, retail, residential, and hospitality. We flirt with industrial periodically. And we have select regions we invest in. Those regions tend to have a high concentration of knowledge-based employment. We favor the live, work, play environments like most people do at this point in the cycle due to millennial growth. And that's essentially our overall investment philosophy. We'll talk a little bit more about it as we go through. I had 20 slides or so, and Natalia cut me back to 3. So
I did. That's true.
My day job is I oversee our investment teams. We have offices in New York, San Francisco, and LA, and I also handle our investment strategy and research.
Great. My name is Michael Gross. I'm the vice chairman of WeWork. Today we are in our 6th year of existence. We have 125 buildings located all over the world. We basically provide creative office solutions for companies of all sizes. The business in its infancy was a solution for really the 1 to 10 person companies where it was very hard to find real estate solution for their needs, and tends to be a big pain point in how they want to grow and think about their business. And as our business has evolved, we've now become a much broader solution where we can service many Fortune 100 companies who are looking for more flexible, more affordable, but ultimately more culturally enhancing work environments for their teams. We're in 38 cities. The business today is global. And we have also just recently launched We Live, which is a residential format and playing off of very much the similar trends of urbanization and sharing of space and sharing of services. So the We Live product is the first 2 are in New York and in Washington, D.C. That's a product that we'll be rolling out more going forward as well.
Well, thank you for that introduction. Let's kick off with a question for all of you. So the value of location, kind of how, as a driver, how do we assess that? How do you assess that? What of the metros, all of you work in a variety of metros, so what are the metros that are most on your radar? What characteristics place them there? And since we are in Miami, how does Miami stack up?
Well, our sources were Sears decided which properties we were going to buy, and those were the ones we bought. But we're everywhere. We're in 49 states and Puerto Rico. It's a consistence of 42 million square feet. We're not in any downtowns. They're much more suburban markets, even if we're in a major metropolitan area. We are seeing interest across the country. We have tremendous in South Florida, California. We're up in Redmond is busy. But we've started our projects in Memphis, Anchorage, Massachusetts, Anderson, South Carolina. We're seeing business everywhere.
Okay.
We, as I mentioned, are focused on knowledge-based employment areas primarily. One interesting thing that's happening right now in the country is we're actually running out of labor, and the current administration is probably not going to help that much. And so there are areas like Portland and Seattle and others that are growing quickly because of the access to talent. And real estate is really, it's occupied by tenants, and the tenants need employees. And so one of the things that we're really focused in on are areas that are conducive to growth. I live in San Francisco, the People's Republic of San Francisco, where we have a great basketball team and terrible housing policies. And so what ends up happening is we are a wonderful exporter of talent to other parts of the world because it's too expensive for people to rent apartments or buy homes or what have you. I guess you're one of the exceptions. You're coming our way. Smart. But in any event, the point is that we're focused in on areas like Boulder. We bought a big apartment project in Boulder. Why did we buy it in Boulder? Well, Google's going from 400 to about 1,500 employees right next door. And you can go on in each of these locations about the value of location. We have what I would characterize as the Navy SEALs of Google and Amazon in 2 of our buildings. And location is, these are the engineers that tell the Bezos up in Seattle where they want to be. So the value of talent is really what's driving location today. I think you guys obviously are seeing a bit of that, but in certain locations, rent is really not a factor. It doesn't matter. Not when the value of the talent can change industries.
Yeah, I mean, location for us is really critical because the whole underlying sort of driver of our business is that we're seeing these massive societal shifts in behavior and how, driven by millennials, but we're actually seeing that it's much broader than that today. But this movement towards urbanization, the high IQ, high momentum cities are attracting more and more of the young workforce. And then, when you look at the numbers, they're pretty staggering in terms of just as of today, almost half the workforce is millennials. And when you look out by 2030, they say 60% of the world's population is going to be in these is basically going to be in urban centers. And so that movement and the underlying fact that most of these core cities today are already very expensive. And so you're seeing the workforce get pushed out further and further. And I think you have a few themes. We look for density. We look for access to transportation. We look for buildings that provide, great light and energy. But I think the underlying, shift is that as we see, the core New Yorks and San Franciscos, the demand is there and still strong, but you're really starting to see a lot of these secondary U.S. cities that are populating markets like Austin where, we can't open buildings fast enough. And that trend, I think, will continue. And I think part of this movement is a more flexible transient lifestyle. And this new workforce does not want or expect to have the dream of the suburban office and the big corner office. And so most of the development that took place in the 80s and 90s sort of pushed people back away from the city, from the downtowns, into these suburban campuses. And I think the big disconnect right now that I think WeWork is part of solving is being able to bridge that gap between this sort of new way of work and giving people flexible solutions and environments that are going to really appeal to a broader lifestyle, and at the same time connecting some of these bigger companies with access to be able to work in the locations in the cities that they want. And I think that's the location driver, and we get to benefit from seeing it as a global trend. As I said, we're in 38 cities today and doing a lot of development now and throughout Europe. We just opened our first couple of locations in Mexico City. We're seeing, in the next year we'll open in Brazil and Argentina and in Colombia and Peru. So just the extension of these kind of cities and those trends are very similar to what we're seeing here in the U.S.
So Bob, you had mentioned Denver for a minute. So when we look at places like Boulder. You had mentioned Boulder or Portland. So these cities that have become known for, historically for some of the tech presence there, and are increasingly being known for some of the kind of tech presence that they're attracting. You also mentioned kind of the role of talent and the labor force in that. As Miami and a couple of other cities, but as Miami strives to be kind of the tech epicenter of the region and combining the northern and southern hemispheres, what are other ingredients that haven't been talked about on the panel yet that we need to keep in mind in order to really drive that growth?
We'll pop up one of those slides.
Let's pop up the slides. I was told that we should
What
just
if
say
they,
pop up the slides and they would come.
Let the tech guys.
Yes.
All right, so this sort of summarizes some of the things. Maybe we go to the next one. It's probably a little bit more relevant. There we go. You guys can hopefully see this. Basically, what this does is it charts, levels of education. And as I mentioned, there's sort of a high correlation between growth of an economy and education. If you take my wonderful geographic region, we have 48% of the folks have very, very high levels of education. And that's a metro region. If you were to break it into subsets, like if you were to go down to Silicon Valley and just take a slice of that or a slice of San Francisco, it'd be far higher. Similarly, the DC region also ranks really high. Of course, they're mostly lawyers that aren't that productive. That's a joke for all you lawyers. And then you come to Denver, and you see Denver actually rates pretty high. Now, if you go down to Miami, it's at 31%. And that's one of the challenges with some areas. That they don't have the raw material. There's no mystery as to why Seattle's growing quickly. Seattle's history is really one of STEM-based science, technology, engineering, math, et cetera, because of Boeing and the agricultural business, natural resources. And so those areas that have sort of the raw material, which is the employee base, tend to do well. These aren't all the markets in the country. They're just sort of our favorites that we invest in. And we're looking for those areas that have these attributes, and also the areas that are the up-and-comers. Portland, I mentioned, is an up-and-comer, and it's one that we're invested in. And we're in office and apartments and hotels and retail and so on and so forth. So you can play different elements of the market. You can also play up and down the capital stack if we want to do preferred equity or debt or what have you, or long-term development. I think what you're seeing in social media and in the media business in general, I think spells a pretty good future for LA, particularly the South Bay of LA, which has a lot of the satellite government sort of employee base, some of the similar attributes of Seattle back in the day. And I think you'll see more growth in parts of West LA, particularly as it going down towards the South Bay. Coming to Florida, I think for Miami in particular, we invest here. We have a lot of different investments, and it's kind of like Phoenix. It's get a jail-free card is population growth, and it's becoming a gateway city, certainly to South America. And so it has a lot of positive attributes. It has wealth coming in from New York. It's got wealth coming in from other parts of the world. The biggest challenge, I think, the raw ingredient is it doesn't have. Like in the take Boston, you have Harvard and MIT and so on and so forth. It doesn't have the educational institution. I think that's probably, you talked about the Innovation Center. At University of Pennsylvania, they have something called Pennovation, and they're looking to extend their reach. You probably know a bit about it. And it's all about sort of increasing the bandwidth, human bandwidth of education, and particularly in the STEM sciences.
Well, I mean, stemming off of education, and this is kind of a bit to all of you, whoever wants to kind of engage with a question, let's talk about millennials. So looking at the audience, and no offense meant, but I don't think there are very many millennials among us here today. But they're the largest, at this point, the largest kind of block in terms of our growth. Demographically and kind of as a psychodemographic as well, kind of extended beyond that. So how have they driven the changes so far, and what should we be really looking forward in terms of millennial behavior changes and how that affects this industry?
So, I think as I mentioned earlier, our business was really formed around a solution of really addressing a pain point for many young entrepreneurs who are getting going in their careers. And when you think about real estate, which is this incredibly it's this fixed cost that really has very little elasticity. And when you're starting a business and you're trying to extend that business and make decisions, those first few months are critical, and you get a little momentum, and then it's this concept, the disconnect of sort of, you know, real estate being so fixed and longer term, and your needs being really short term, and your business, you know, really needed to expand and contract. So what we see underlying with millennials in terms of behavioral patterns is, number one, you know, the lifestyle aspect is huge. They're willing to take, you know, less space, and many times, you know, they genuinely cherish, you know, experiences over material goods. It's a generalization, but it's something that, you know, it's really consistent in I think the behavioral patterns. And so, you know, what we've really seen in the evolution of that is the willingness to take less space, share that space, be part of something bigger than yourself, give back. All of those attributes are you know, really I would say a new, you know, style of approaching work. And I think the underlying change that is what's fascinating is to see, you know, most large corporations are not run by millennials, and yet the lion's share of their employees are. And there's a cultural challenge for many big companies today to say, how do I make my environment relevant for my workforce, and you know, change to meet these needs? And I think, you know, you're seeing more and more companies, and that's something we're touching today. More and more of these companies are starting to really realize that real estate and their space is so vital for their ability to retain and recruit talent. And, you know, I think that's something that you touched on. But if you're gonna, if you're gonna not give an environment today that people are excited to come to work and have, you know, it's gonna be really difficult to do that. And that's, I think, the biggest shift that we're seeing.
It's interesting, and I'm not sure if it's millennial driven or what have you, but you know, hotels are starting to look like office buildings, and office buildings are starting to look like hotels. Or where, you know, in the case of office buildings, you've probably been reading in some of the press, landlords now are offering concierge services and so on and so forth, providing perhaps some of the same things, maybe not the beer pong, but you know, some of the same things that you know, you would get in a hotel. And so, I mean, each asset class is being impacted by the millennials. I mean, in the case of apartments, you know, more apartments in the urban areas, so that's triggering retail demand in the urban areas. Our apartment projects, I mean, I can go on for a long time about sort of some of the impacts. I mean, from Amazon lockers, you know, delivery lockers, to the need for more storage, to the need for less parking, and so on and so forth. The average unit size getting smaller, and it goes on and on. I guess when you come from a dorm, it's not that bad being in a WeWork's office or in a micro apartment. So.
Yeah.
So what we're seeing is, and I don't think this is a surprise also, but the experience is very important in retail right now. And it's not just about going to shopping, it's the entertainment, it's the socialization that you do when you're at a mall or a center. A lot of centers are trying to bring the daily trip, the gyms and supermarket experience right to the mall, which is not revolutionary, but it's happening a lot more frequently now. And also the level of design of the centers has, I think, risen quite a bit in the last 10 years, because people do like to shop in better experiences or go and hang with their friends at something that's more nice. And so that's what they're doing. And it's, you know, it's part of what we're doing is we're transforming, you know, the old Sears building. And you'll see in some of our projects, we're trying to do it often collaboratively with the mall developer if we're on a mall. But often you'll go and, you know, it's pretty incredible what you can do to a building and how you can make it look, you know, modern and how the consumer reacts to it. So.
Yeah, just to follow up on that, I think a lot of you know, the challenges, there's a design component of this, which is obviously critical, and I think millennials and just overall, there's a desire for a more authentic experience, something that feels real to them. And so what we see is it's not enough just to design beautiful space. that is something that can be replicated. But it's really in the curation of the space, and it's in how you activate that space. I mean, why technology is such a huge part of our business is because technology really is the connective tissue that allows us to have our 100,000 members all over the world basically be interacting on a daily basis with each other, sharing ideas, offering, hey, I'm looking for a graphic designer and I need this. And so you're able to expand outside of just the physical walls, which is a huge component. And at the same time, the technology of how you're able to manage and operate your spaces and be able to communicate, hey, there's an event, there's a speaker, there's a demo day. All of those things, if they're not sort of built into your space and built into your real estate, it makes it much more difficult to be able to activate those buildings. And so the technology side of this is something that it really allows and fosters the space to be not just more efficient, but ultimately far more enhancing to the overall experience for all of our members and the space itself.
So what happens when millennials age? When millennials start having
Well,
children?
I turned 40 last year, and as my partner and the founder of WeWork said, I was officially off brand. So I took that in stride. But the reality is our biggest growth today is people over 40 years old, and they're starting second and third aspects of their career, and they just want to change. Our tagline is do what you love, and they're at a different stage of life. And we have so many. We're based in New York, where we have north of 35 buildings, and so that's our critical mass city. But you walk around today, buildings in Midtown Manhattan that are WeWork, and you've got it's as many law firms or hedge funds. So I think the evolution is this is a mindset, and we used to say it was really a millennial, but we say now it's more the we generation. It's sort of this desire for a different way of working and living. So what we see is as our base matures, the needs, you still have to address that basic underlying. People want flexible space, and they want to be able to utilize that space and kind of grow in and out of it. But as the membership grows and matures, the ability to offer a new range of services, and that could be different healthcare packages, it could be daycare centers. There's so many aspects of what we're doing today that sort of meets the needs of a growing base and a growing a growing audience that I think 6 years ago we didn't have the capacity or the ability to meet those needs, but today it's we're seeing it's a big part. And even when we talk about We Live, the reality is the demand for housing in these big urban centers for empty nesters is massive. It's a huge opportunity in the market today because there's a desire again when that density and living in the city and having all this energy, being able to provide a whole different generation to that is something that I think if you look out over the next 5 to 10 years, it's going to be a huge value driver.
Yeah, so some of it's secular and some of it's cyclical. So what's happening, and I can go as far as just serving sort of people within our company. So they buy the condo or they rent, and then they buy the condo in town, and then they have a kid, and next thing you know, they realize that they can't get into a private school in San Francisco or in New York or what have you, LA. And so then what they do is they move out to the first ring. They're not moving out to the third ring. And I think the suburbs that are likely to do well, and the ones that we are targeting, are the ones that have urban attributes. And so those, and you guys are going out, you guys are going to Bellevue and areas like that you historically wouldn't have gone. And so you follow your customer, and your customer is going to go out to those areas. The other is, and you mentioned the boomers, I guess I'd really be kicked out of your company. I'm a lot older than you. But the point is that you have a lot of people that are the empty nesters are moving into the urban areas, but you also have a fair number of boomers that are renting. And we all know what's happened with wealth. And in some instances, I think people out of necessity now are renting because of perhaps in their retirement years not having as much money as they once had in 2005, 6, 7. And so that may be out of necessity. And the value proposition of owning, I think perhaps it got a little tarnished in the last cycle. So you don't necessarily need to own. You can rent, and in some cases that may be a better thing to do.
So James, you and I had talked a little bit about this yesterday, but I'd love anyone else's thoughts as well on this. I'm going to be a little bit contrarian just on purpose to kind of get us to the polar extreme. But I get my groceries from Instacart. I haven't gone to a grocery store in I don't know how long. I have daily Amazon deliveries of every random thing that I need. I purchase most of my things online. So what's convinced me that brick and mortar retail is not a thing of the past?
So one thing is there's always been disruption in the industry. Right? Department stores used to be in downtowns in the 1800s, and then they went out to the suburban shopping centers in the 60s and 70s. And then there's always been bankruptcies and consolidations, Federated, buying up a lot of department stores and then merging with Macy's. That's nothing new. I mean, and having to backfill spaces. And even less than 10 years ago, there were bankruptcies just due to competition. I think Amazon is, just to use the name that's probably, they're the largest. They're predicted to, not yet, but they're predicted in the next 2 to 3 years to have larger gross sales of goods than Macy's. And I think that's interesting. But if you go to goods centers, you still see a lot of people. And you see a lot of people with bags. It's a lot about food and beverage. It's a lot about what entertainment is there, as well as the shopping experience. And for me, I think it's just we're all still social. I think a majority of us want to get out and get out of our houses and do things. I mean, WeWorks, they want to get. You could sit in your apartment and start a business, but they don't, right? And it's a good price point, and it makes it affordable for somebody to start a business, and it's a network. So there's that. I just think that's not going to change, no matter what generation it is.
Any other thoughts?
Yeah, oh boy, where we go. All right, so we invest in retail that is internet resistant, or it's either trophy or trauma in retail right now. And so we're working on a property in the New York metro area where it's a retail center that has no economic reason to exist anymore, so it's going to be a scrape, and we're going to build a lifestyle center similar to one we own in Orange County. The one in Orange County has retailers that are experiential. You can eat, you get coffee and so on. And it's a community center. We have a farmer's market, and so it creates a sort of an experience for people to come shop. And that's the kind of retail we want to invest into. Now, so what has e-commerce done? I get Amazon and so it's fun to watch them. So they use predatory pricing to drive Barnes & Noble and Borders out of business. And now they're coming back into the business. Classic strategy. But there's actually something that really Amazon and the other e-commerce retailers have done, and that is they've created price transparency. You can't buy a tennis racket, you can't do anything without having a pretty clear understanding of what pricing is. And so the local sporting goods or what have you has really no pricing power. And that to me, you used to be able to rip off some, when there was no information, it was easier to sort of have non-competitive pricing, but now everything's competitive, and that whether it's in hotels or in buying a tennis racket. The other is in Amazon Fresh. I was in one of our, we did one of these really authentic, cool rehab deals in Jersey City, brick and timber apartments, and it's lofts, and everybody loves it. So you go in there, the parking's underutilized, the storage is at capacity, and there's a waiting list. And there's Amazon deliveries, Bonobos too, but we won't worry about that for today. He isn't here, so I'm not going to give him any kudos. And what it's doing is it's actually hurting Whole Foods, and it's hurting the restaurants. And if you're not going to a restaurant, you're not going to consume the other things. And so this all has sort of a spin-off and an effect. You probably read in the journal or what have you today, the QS, the quick serve restaurants, they're having some problems, and that is we're over-restauranted, and people are are consuming at home. You have delivery, I guess, you guys have We Eats, or is it just Uber Eats? Anyway, there's a lot of delivery stuff going on. So, Wheaties.
Yeah.
There you go.
Yeah, I mean, I think from an overall like retail perspective, I think getting back to sort of millennials and behavioral shifts, I think number one, the branding and if I think about like branding, and 10 years ago it was big brands, bold, wearing on your shirts, and today it's really so much more subtle than that. And so, what the consumption is and where the focus on allocating dollars, I mean, I think much more, as I said earlier, towards experiences. That might be travel, that might be events, music festivals, as opposed to buying, those, really, expensive sweaters, and minus sneakers and maybe hats, where there's still a lot of consumption there, or discretionary consumption. But I also think luxury itself, or the definition of luxury, is changing so fast. And this, these, marble and sort of, super high-end goods. It's like, even from the restaurant perspective, it's being able to walk in place, be yourself, be able to put on a jeans and a t-shirt and a pair of sneakers and be comfortable in your surroundings. And I think, retail needs to shift to accommodate that trend. And I think a lot of retail centers, you walk in today and it's like, it's cold, it's not welcoming, the energy isn't there. And, there's going to be, really great smart developers like my friend to the right, who are going to see opportunities to sort of rethink those. But I think, the retail environment, there is a need for social, and I think that's a huge component of why our business is so successful. At the end of the day, we are really a physical social network, and everyone who, if your whole world is just on your phone, and there's even, we see it with a lot of our young employees, like there's a different ability for them to eye-to-eye contact and communicate. And I think bringing people together is hugely important. And I think as technology only gets more and more part of our lives, I have 3 daughters under the age of 10, and they're already so here that making sure that there's environments for them to connect and really be able to, have that social experience is going to be incredibly important. It's just going to be, I think, in a different box than it looks today.
Another question for you, James, kind of piggybacking off of what you mentioned. What dynamic are you seeing, and kind of how do you expect the relationship to change between kind of street retail and malls? Kind of what are the pieces that each one is getting right, that each perhaps are they merging, are they distancing? Kind of what's the dynamic there?
So this is somewhat new. We haven't started yet, but we're exploring going into bringing the mixed use concepts to a lot of malls. I mean, there are places that this is happening, but integrating and making streets at the mall and putting residences over top of the retail, and, basically the urbanization of a suburban area. And I think, I think we all live in cities, and we like that experience, and I think that a lot of people tend to look for that too, and more so than the urban and rural environments today.
A question we haven't talked about, so we've touched on retail, on commercial, obviously. We've touched on kind of private shifts in kind of the work, live, play concept. We haven't really talked about hotels. Obviously, we're in Miami, so I think we'd be remiss not to talk about hotels and the tourism industry with entities like Airbnb, with Rome, which opened here, but I think just opened in Tokyo and has a presence here as well, and I think is in San Francisco and is further expanding. So this idea of kind of a different experiential way of traveling that doesn't quite that counterposes to a certain degree to hotels. What should we be expecting, and how should the hotel industry be adapting to this?
I'll jump in. Prior to joining WeWork, I was the CEO of Morgan's Hotel Group, so we had a few hotels down in this area, Delano and Mondrian and Shore Club. I think actually there's a lot of parallels to what WeWork is doing to commercial space to what effectively my predecessor, Ian Schrager, did 30 years ago in hotels, which was how do you take these white boxes and create theater entertainment in the lobby and a social community, and then around that community, basically, sell rooms upstairs at a premium. And I think that it's an interesting time right now because I think the shifts and I think in general the hospitality world is quite crowded with brands and lots of people trying to do experience and. I think that's a hard game to play when you're just trying to be, cooler than the next guy and then the next guy, and you're sort of in a vacuum of playing that. And I think the Airbnb model is so powerful and it's something I think we see so much. It's sort of like this concept of a more personalized solution of walking into someone's apartment. Sort of being able to have access, not ownership, be able to, stay for a week or a month. And when we think about WeWork over the next 10 years, like our vision is you're going to have kids maybe not even going to college, but certainly graduating college who are saying, this is what I just became a member of We, and I have access to apartments and offices all over the world. I've got friends. I live 3 months in Miami. I'm in Berlin for 4 months. I spend 2 months in Shanghai, and I take 2 months off. And by the way, I make $42,000 a year. And I think that's like really, when you think about it, you can be a WeWork member and between WeWork, We Live, it's, you can have that exact storyline and spending, $1,500, sub $2,000, a month. So I think that the hotels have to respond. I think hotels are, the benefit is they have the meeting rooms, the spaces. So as you start to try to get into that business traveler and group segment, it's very difficult for an Airbnb to sort of compete with that. But I think the hotels are going to have to shift and do it quickly.
Yeah, I agree with most of what you have to say. Airbnb is yet another startup in San Francisco. They have 50 data scientists and growing. So why do they have 50 data scientists? That's because they're mining all the data of all their members in order to cross-sell them theater tickets and restaurants and yada, yada, yada. And so, and the same thing, is, they're talking with EQR and the apartment owners now. The apartment owners have all these bodies, but they have to actually figure out how to capitalize on that data. And so a lot of this is about data and capturing that data and cross-marketing it and so on and so forth. The hotel industry, I think, it's over. There's too many of them, and there's sort of the Airbnb effect, and there's, frankly, again, total price transparency. That started about a decade ago with Expedia and Hotels.com and so on and so forth. It's a tricky business, and you mentioned the experiential side of it. Well, as an investor, if I want to invest in a hotel is an operating business. And by the way, if the food and beverage is now 50%, like the standard in New York, am I really buying a hotel or am I buying a bar? What am I buying? So it's an interesting situation, but it is experiential, and I think what Ian Schrager did and some of the others, Equinox, I read about that. I think they're going to be doing an Equinox branded hotel on the west side in Hudson Yards, I believe. And I think that's great because it seems to me like it's a surprise when they go to a hotel and they actually have a good gem. Equinox obviously will capitalize on that.
Hotels, that's an area we're looking at, and in the mixed use environment, also getting the transients and the day trips, but it's a lot trickier on structuring those deals in a joint venture way, and so we just haven't gotten into it yet and haven't explored much of it.
Just the one thing I think that underlying trend, and again, going back to millennials, but I think much broader, health and wellness is such a driver of people's decision making today, and it goes way beyond the food, the exercise. Just it's really lifestyle, and like Denver's a market where we have a few buildings, and it gets to the lifestyle where we used to throw happy hours at whatever it was 6 o'clock. And our members came back and said, no, we're living in Denver, or because of this great lifestyle, and we want to get out. And so, that their work days might, their work days might end at 4:30, and because they want to go, and they're going to go do a hike and go for a run, and they're back at their computers and working late at night. But it's those are sort of the shifts that we see pretty consistently, and I think health and wellness is going to be, from a product perspective, a critical component of meeting the needs of this generation, and it's very clear that that's not a fad, that's a permanent shift, and it's moving quickly.
So I'm going to start to wrap us up a little bit so we make sure that we leave room for questions from the audience. But switching gears, pun kind of intended, but mostly not, driverless cars. So kind of what's the horizon on something like that? What's the horizon on that impacting how we build and how we operate our facilities, how they are full, what the usage patterns and kind of the urbanization. You mentioned the reurbanization trend, Michael. So kind of what are the expected effects of a trend of a rising technology like driverless cars, and kind of when should we expect those trends to start to come to fruition?
Well, to that, the second part of the question, I have no clue. I don't know when it's going to come, but it seems like it's inevitable. I think what you're really touching on is sort of like these cities' infrastructures are not built for this density. It's just not. So what you have, and what we're seeing is our product is expanding, is it's not just, it's being in the core downtown, but that drive from San Francisco to Palo Alto that used to take 40 minutes, probably today takes close to 2 hours in traffic. So what we're seeing is the ability to populate WeWorks along the way, and so if you're a member of a location anywhere, you basically have access all over the world. So it's almost like a gym model. So dealing with the traffic component is hugely important when you're thinking about logistics and being able to serve the needs of these new workers, because whether it's driverless cars or high-speed trains, the reality that those things are coming, and they'll probably take a little pressure off. But at the end of the day, the infrastructure is not there. These cities are overcrowded, and I think it's going to be very, very interesting. I mean, one of the amazing things about Miami is you have this amazing city, beautiful beaches, you have a downtown that's thriving, that you've got so many components here that 10 years ago it was piecemeal, and you didn't really have the density downtown yet. Wynwood didn't really exist in its current form as sort of being a creative center, and you had sort of the beach, which was sort of viewed as a place to go party but not work. And so 20 years ago when I graduated college, I moved down here and got to experience that, which was fun. But the reality is today, I was out for dinner last night in Brickell, and just so blown away by the pace of change. And there's a legitimate urban downtown in Miami you can have the weather, you can have a relatively low cost of living, and you've got that urban center, and you've got all this other stuff around you, which I think is going to make Miami as one of the most attractive cities to live in. If you can if this ends up being a world where you aren't tied down by a job of being, you can sort of pick where you want to live and then make your living. It seems to me like Miami, looking out over the next 10 to 15 years, is only going to get stronger.
Topic was driverless cars.
Topic is driverless cars.
Right, so a couple things. Tesla's based in the Bay Area, and Google's driverless cars are actually in one of our buildings, which they actually just bought from us. And it's Google's X division that is doing that, and they've just spun it out. It's now a separate company. They've become more financially disciplined with these moonshot projects. But nonetheless, so I don't know. The theory here is that driverless cars will alleviate traffic, reduce congestion, accidents, so on and so forth. I think that's probably true over time. My sense is the adoption will there's regulatory issues, and we've all read about the Tesla car that got the roof taken off as it went under a semi, and so on and so forth. I actually think an interesting trend is if you're not driving and there's less traffic, you could actually move to an outer urban or suburban, however you want to call it, location. You can actually move out further and read your Wall Street Journal or whatever you want to read on your iPad as you're driving in. So there's some interesting cross currents with driverless technology.
So the regulatory jurisdictions haven't caught up to technology, and for now and for a long time, we're still going to be required to provide four cars for every 1,000 square feet of retail we have a center, or 1.75 cars for every residence we build. So, we're going to have to build it. I think that if we have surface parking, and over time that the need for parking goes down, that'll be opportunity for additional density at sites. If you're building parking garages, what do they turn into as there's less cars? I mean, somebody will be creative and find a use. I mean, Bob and I were talking earlier about how well the self-storage industry does, because as people are moving into smaller houses, they don't really get rid of everything. They stick it in a storage unit. It's very likely that over time, if you've got a residential building and it doesn't have the parking demand, you could convert that space to storage.
What else is happening on the technology front that we should be keeping an eye out for around the corner?
Machine learning, artificial intelligence, genomics. These are all things. I mean, at the end of the day, the solution to cancer and a lot, it's all about raw computing power, and raw computing power is going up more and more, particularly with the cloud. So distributed computing and these massive supercomputers. We'll probably have solutions for this, and a lot of it's happening in whether it's in Cambridge or in Mission Bay and UCSF in San Francisco or down in Silicon Valley, and a lot of it's about data and big brothers. All kinds of discussions you can have there about ethics and so on and so forth. I mean, collecting the data is great, but what happens if it gets in the wrong hands? So there's just a lot of interesting things that are probably going to happen in our lifetime that are really, really super exciting. And they're very concentrated in only a few locations. I mean, Seattle's got some stuff there in Bay Area, San Diego, and you come back to DC and obviously Boston. Probably New York's got a bright future. I mean, at one point, Google only had a little bit of space, and now they've got over 3 million square feet in New York City, and that's because it's a recruitable location. It doesn't have an MIT or Stanford or what have you. It is a landing spot for a lot of folks, so it's very easily, and you guys know, right? I mean, it's a great spot for landing talent. So I think in there's a lot of initiatives in the biosciences and so on and so forth in the New York area. I think that's an up-and-comer as well. So.
Yeah, I mean, for us, where we invest heavily in technology, I mentioned earlier, sort of on the member-facing side, which is our app and connecting the members, but we have what we call WeOS, which is sort of the operating system for how we design, manage, and operate our buildings. And you can imagine, today we're adding between 10 to 15 buildings every month globally. And so that type of consumption of space, every dollar a square foot we can shave off of cost, or every day we can build it faster, long term for us is huge. So it's really thinking about, we're spending a lot of 3D technology, also how we can market space. So historically, we're selling our buildings in construction zones, pre-opening until, a day or two before they open. And now we have 3D renderings where you can be giving, basically tours of buildings that are opening in 6 months, and really walk through it, see it. And so those types of things for our businesses, and I think for the utilization of space is a huge, I think, opportunity. And I think we're going to see more and more of that, not just from WeWork, but as an industry. I think there's a lot of opportunity to invest there.
And there's big initiatives. You've heard of, obviously, Facebook will Oculus, which is virtual reality you put on your little headgear. But there's also, for those who play, Pokemon and the augmented reality. I'm sure all the millennials know all about it. But that's going to be exciting too. I mean, the ability to see what you might look like in a pair of pants or what have you, I think has implications for retail. Being able to tour an office building without actually, before it's actually built out, your TIs, and see how it works. And so there's all kinds of companies that are working in initiatives there in the real estate services area as to how to capitalize on that opportunity. It's a pretty exciting time. Obviously, there'll be winners and losers.
Anything?
It's basically a lot of the same things. It's not disruptive, but the technology that we're seeing in the construction side, making efficiencies in design as well as efficiencies in the actual construction of buildings and the improvements of it. The cost of lead, that's come down significantly, and it's bettering the quality of buildings and the heating and cooling cycles of buildings, and we're just getting better at doing those things. Again, it's not disruptive, but it's a cost savings that can get implemented. And the other thing is on the entertainment side, there's a couple concepts that are going to start rolling out this year, and in the VR space, that's going to be, I think, somewhat mind blowing. That again, there are things you need to do outside of your house. Are the ones I've seen. It's like they're really making sure that you need to come out of your house to have this experience.
Yeah, just the one other thing I'd add is, for us, it's not just density and sort of compression of space, which is twofold. One is it makes it more affordable, but actually with density and compression, there's more energy, and the overall experience is enhanced. But it's also it's really space utilization. We look at our own buildings. Our buildings at peak times are only around 65 to 68% occupied, and that's pretty consistent for a lot of office spaces. And so it's the ability to, through data analytics and technology, start to better utilization of space, which will end up leading to I think tenants needing less space but being far more productive with it.
One thing on office, we didn't really talk about, and for those of you who actually are in the office business, this densification, which has resulted in less net absorption of office space than has historically been the case because you're cramming more people into the same square footage or less. It's actually creating issues with regard to load. The vertical transportation will render some buildings obsolete or not. HVAC and restrooms. So all these things, there's a plus and a minus to density. There are companies that, in fact, we renovated a building in San Francisco. We bought it in the 2010 time period from the bank, foreclosure, and we renovated it. And the tenants that we put in there, Macy's.com, interesting. Thank God we sold it. And then Riverbed Technologies, and they had like 140 square feet per employee, and I've heard of densities even lower than that. I'm not sure I'd want to work in that environment, and I think it's a real social experiment as to how well collaborative space works for certain industries. It may not necessarily be a good fit. So.
Well, on that note, I'd love to open the floor up for questions. I know there are a couple of people walking around with microphones, so thoughts, comments, or more of the question variety, less of the comment variety.
So I'm looking at the Rockwood map, and it looks like a political map. The question is, all these urban atmosphere changes, these dynamic things going on, what's happening in the rest of the country? Are they going to lose population, lose economic opportunity?
It's a great question. There's winners and losers. It's not all, sea of roses or whatever you want to call it out in San Francisco. You probably read where people are throwing rocks at Google buses and so on and so forth. there are people that are getting disrupted. There are people that live in the Mission District, which was historically an affordable area, and next thing you know, they're getting pushed out as rents rise and so on and so forth. There are other parts of the country that, I think, obviously, the auto industry, part of that is due to changes in the auto industry. We're in a global labor market, and so you can design and source labor, throughout the world. But, when one thing becomes a train wreck, sometimes, there's an opportunity. I think battery technology, there's a lot of infrastructure in Detroit, and there's a lot of, slack labor. Google's in Detroit, and there's a battery manufacturer in Detroit. So, and there's some things going on there. So while it's not dynamic and it's not on our map, and I'm sure there's probably a bunch of great deals in Detroit, just like there is in Boise, Idaho. You can only do so many markets. It's just that those markets, are easy on entry and tough on exit, and it's just tougher to get your arms around the employment growth. But when you have the raw material, look what happened to the textile industry. It sort of got hammered. And then you had data centers go into former, and we used to own a portfolio of data centers, which is a whole hour discussion unto itself. But what do you need? You need, infrastructure. You need a lot of power and cheap power. So these former textile mills were repurposed. And so I think for every area there's an opportunity to reinvent itself, and that's what is probably great about America. Not that I support our current regime.
Is this thing working? Oh, there we go. Well, you guys were talking about driverless cars. The thing that I'm curious about is, people with cars. Do you really think driverless cars is gonna get rid of people having cars? Because people are still gonna. I just think people are still gonna have them, or they may just have cars that are driverless that they just want to park or something.
So I'm a little bit of a gearhead. So I'm probably the antithesis of the shared economy. I don't always share my car, and I have more cars than I have people in the household. So but I'm probably not the generation. I think the younger generation. For example, when I was in Jersey City, at our project there, a really cool renovated product, and very few own cars. So I think it to some extent varies by geography. If you're in Phoenix, you need a car. Now, maybe if you're living in downtown Phoenix, there's a lot of housing being built in Central Avenue and so on and so forth. So I think that, I think there's going to be a reduction in the number of cars owned over time. I don't think it's going to be as quick as everybody thinks. I think, like a lot of things, the uptake takes a while. And I'm not planning on dying anytime soon.
Hi. I had a specific question. I want to return to the question of virtual reality because I have some friends who are in that industry, and recently I went to one of their events. They were doing something with virtual reality, and they're doing these video games, and they're really immersive. You literally feel like you're in the game, you're shooting the person on your own, and that kind of got me thinking, personally, in the future, in about maybe 10 to 15 years, is it possible, and if it is, that a lot of people will be living in this virtual world and they will have no need for the likes of entertainment or actually physically moving anywhere or even living anywhere, technically. Because, really, at this point, the way it is, I see it happening in about 10, 15 years. Now, this sounds dystopian, but really, it's possible. If this does happen, or theoretically, what do you think? How do you think that would affect real estate and our profession, our industry in general?
Oh, shit! Well, I'm not a futurist. I don't think any of us are. Hopefully there's not a world where we just live with an Oculus thing on our head and so on and so forth. It sounds kind of depressing to me. Maybe to reduce crime, we could actually do virtual crime. So virtual dating too. You could just figure it out. So I don't know. That's a tough question. My sense is kind of like we talked about. I think one of the things that WeWork has done is it's a sense of community, and the same thing's happening in the office sector. I live in one of these areas that has these homes, and everybody bashes out the home, remodels it, and creates the kitchen family great room. That's effectively what's happening with office buildings. When we rebuilt our office space, we created the kitchen, sort of the great room for everyone. So I think there's a need to collaborate. Now, I guess like FaceTime, is that collaboration? Well, sorta, and I guess virtual reality could kind of be, assuming it wasn't an avatar, it was something real.
Hi, this is a question more focused towards Seritage. I was wondering what your thoughts were on the viability of department stores moving forward, given the recent weakness in sales, and then more specifically how that pertains to Sears within your portfolio and what their viability is moving forward.
So we watch it very carefully. Actually, Macy's closing stores is competition for us when we're trying to lease a Sears building. We have very little overlap with where they've closed, but it is competition. When Sports Authority closes, that becomes competition. Department stores, just like all retailers, have to reinvent themselves more frequently than they generally do. And I think the good ones still will. When the viability of Sears, they just had an announcement yesterday or 2 days ago. They give a lot of visibility into how they're trying to fix their business, to be determined. But I think there's a lot of runway for us if something ever did happen. That's just more opportunity for us, more opportunity for other people to repurpose real estate. I don't believe we're going to live in a virtual world where we only socialize through VR. But
Yeah, we haven't talked about, I'm surprised we haven't brought up the word omni-channel.
Yeah.
It's like, the hot thing in retail. So I think that department stores and other retailers that can become omni-channel, one of the big issues, and I guess Bonobos has sort of cracked the safe on this one a bit, is you need to have an experience of returns, and then they can upsell you and so on and so forth. So I wouldn't be surprised if Amazon, whether they bought a Sears or Macy's, if they got into the bricks and mortar side of the business. Because you do need, one of the big issues is sort of the logistics of returns and so on and so forth. Right now, Amazon is subsidizing, which is great for all of us, but the long term of that is debatable.
it's also not efficient.
Yeah.
Sending packages
Well, the last
back,
mile, and that's
right,
why you're
yeah.
seeing Amazon go into the urban areas is, in order to get closer to your customer. So
I think we have time for one more question.
I just have one question regarding different cities that you feel are going to be expanding. You mentioned Austin as one of the cities earlier on in your conversation. Are there any other cities you see expansion or companies moving into?
For our business, it's actually we're in to date, with the exception of Phoenix, we're on the which we will be Scottsdale, but
Old Town.
so we're in all those. But we're also interesting. Austin, Nashville, Dallas is actually a market we just opened, which has some strong demand. Interestingly enough, Detroit's a market that we just opened our first location in, and tremendous amount of enterprise. So what we can feel demand both from the small little companies, but also from big companies that are looking to move satellite offices. And surprisingly enough, Detroit is a market where a lot of companies, Pinterest just moved an office into a WeWork. So I think those are a few. Where Minneapolis is another market where we're not in yet, but we are. We will be, and we're also seeing a lot of momentum there. So I think those are some of the extended, sort of secondary cities that our model is moving towards.
Yeah, I think you have to put a time frame on it, and we have long and short term, tactical versus longer term capital. And if you could play the 10 or 15 year cycle, it's different than playing the 5. And a lot of them are already elevated. I mean, the Bay Area, the big issue is not just recruiting, but retention of talent. So, while it's seemingly a good market, it also is hyper competitive, and so it's not necessarily that easy. That's why you're seeing a lot of firms open up an office in Seattle or in Portland, because of the access to talent and the ability to retain the talent, putting aside rent and labor, salaries and things like that. So I like Denver long term. I think parts of what's happening in the media industry. I mean, Amazon Prime is at the Sundance Film Festival. Go figure, right? So there's a lot going on in the content business, and sort of LA is epicenter for that. And you probably have read about Google down there. They have a YouTube division down there, and they've subsequently bought a lot of property and are expanding there. And it's no mystery. YouTube produces talent, and I think ultimately they're going to leverage that model, and that'll probably be an area that will continue to grow. We're investing there. I'm sure you guys are looking at. You guys are down Manhattan Beach and a few other spots down there. Manhattan Beach is awesome for the talent and lifestyle and all that down there. So
on that note, I want to thank our panelists for joining us and driving such a great conversation.